Good morning and welcome this morning to Long Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Scott Thompson, who was with me earlier this morning in my Trading Futures webcast. He is back again for a repeat performance. He's a great opening act and got that conversation flowing and going already out there in the chat. So I'm glad to have Scott with me to help out. I'm filling in for Connie Hill, who's normally in this particular webcast on Tuesday mornings. So we're going to talk a little bit about long options. Interesting kind of market this morning. We're in the heat of the battle when it comes to earnings season, but at the same time, we've got a bit of some movement around, given the fact that we had a cool CPI this morning, and we've got Kevin Warsh Fed discussions. Fed speak going on today, kind of as we speak, as a matter of fact, and that's moving markets around a little bit. We're going to talk a little bit about VIX and volatility as we get into this discussion this morning and take a look at maybe some areas where we might look shorter term for long options as well as maybe some longer term trades as well. As we get into this discussion, though, a couple of quick housekeeping items that we need to take care of as we get started this morning. Remember that everything we talk about is simply for illustrative and educational purposes only. It is not any kind of a recommendation or solicitation of a particular account type or strategy or anything else. With that said, everything that we talk about is intended for general informational purposes only. Schwab doesn't recommend the use of technical analysis as a sole means of investment research. We're going to be using the Thinkorswim desktop software platform, specifically the paper money version of the platform. It is a great learning environment. However, it's not a guarantee of future success. One of the main differences is that orders will fill at the midpoint in the paper money platform, whereas in the paper trading or in the live trading account, they will fill based on actual market forces. And so that is a difference. Now, when we talk about options, since that is the focus of today's discussion, remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any options strategy. As we get into this discussion, we will talk about some of those specific circumstances regarding options along the way. Past performance, no guarantee future results. Probability analysis is just that. It is probability and it is theoretical. So it is not a guarantee of what might happen out there in the future. So we'll jump into the discussion here really quickly and start talking a little bit about what's going on this morning in the S&P 500, taking a look at the future, the index here in the SPX. Down a little bit at the open and then now rallying back up and now kind of coming in a little bit of a spinning top, if you will. That spinning top candlestick here, not quite a doji, giving us an indication that maybe there's a little bit of equilibrium, but I think less equilibrium perhaps than this candlestick might imply. That would imply that equilibrium occurs kind of averaged across all of the instruments within the S&P 500. Because as we look at the NASDAQ a little bit higher here, see some of those technology names coming roaring back into the mix here, though not hugely roaring, more so than the S&P 500. Take a look at the Russell 2000 here and the impact that the Russell 2000 has. It's kind of sitting here at an impasse as well. Now, that being the case, the next thing I want to take a look at, given the fact that we've got markets kind of in a stasis, but there are some individual names that are in fact moving or have the potential to move, I want to take a look at volatility, because volatility, when it comes to trading options, volatility becomes a part of the discussion. Volatility, one of the three primary factors that impacts option price. One is directional price movement. Two is the passage of time. And three is the impact of changes in supply and demand. And we know that as changes in implied volatility. When there's a lot of demand for options, whether those options are calls or puts, it doesn't matter. when there's a lot of buyers for those options, those prices go up. And if they go up, then that's met with selling pressure, because when there are high prices for things, sellers come into the market and that pushes prices down. So high implied volatility is met by pressure to push that volatility down. Low implied volatility met by pressure to push implied volatility up. So we're looking at the VIX. This is the volatility index of the S&P 500 as a cross section on average across S&P 500 SPX index options over the last 30 days on a cross section across in the money, at the money, and out of the money options. So it's theoretically a representation of the overall volatility of the market. And that's how many investors look at VIX, is as a representation of that volatility. If we were to just keep our evaluation at that level, and we say that the VIX is currently sitting at a 16 handle, 16 half handle, we'd say that implied volatility is relatively low. Implied volatility relatively low might induce traders to think long options. Great. Buy when implied volatility is low, the market moves, or an individual stock moves in a directional fashion, implied volatility goes up, hopefully, and that benefits our trade. But this would belie the fact that implied volatility overall on the S&P 500 represents the market cap weighted nature of the S&P 500. Because if we change the look of the VIX to its constituent components and we make it more of an equal weight to the VIX as opposed to the market cap weighted SPX, then we get something that looks a little bit like this. And this is the VIX EQ, VIX EQ. This is the S&P 500 constituent volatility index. This is related to the implied volatility of SPXEW, the equal weight S&P 500 index. So this takes out that weighting influence of the biggest components of the S&P 500. So when we look at the VIX EQ, you see that the overall volatility index for the market for the S&P 500 is in the 50 handle, not in the 16 handle. That's a huge difference. When the VIX EQ generally runs higher than the VIX itself, but when it's trading significantly higher than the regular VIX, so if I were to just put on here a comparison line, COMP comparison line, and we'll compare this to the VIX itself, to the VIX of the market weighted or cap weighted, you can see those two are going in opposite directions. So VIX EQ going up, VIX, regular VIX going down. So when that disparity is as big as this, there's a couple of things that we can draw from that from an inference basis. It tells us that that market stress is perhaps concentrated not in the mega caps. Those might be the safe havens when it comes to volatility, but the smaller, more economically sensitive, more cyclical stocks tend to be where that stress and that volatility is categorized and kind of hiding, if you will, almost. Now, if we were to see this move in the opposite direction, right? If you were to see the VIX, normal VIX, VIX, now start to move up and the VIX EQ moving down, that tells you something. That tells you that there's probably more risk in those mega cap technology, primarily names that are driving the S&P 500, and that rotation is coming out of some of those smaller cap names or some of the more economically sensitive cyclical stocks, if you will. When those start to come together, that can be a kind of a systemic impact, right? When volatility rises in the small and the big caps, mega caps, and volatility falls in some of the other areas, that relationship can be something that we need to pay attention to. But here's where we are. VIX EQ is at the highest it's been for a year. VIX as a whole, VIX, regular VIX, is down near the lowest that it's been. So where do we go? Because as long options traders, we want ideally low but rising implied volatility, yes? Because that benefits us as long options traders. And it certainly would maybe benefit, we get a double kicker if we were to look at, say, for instance, a long put option where a continued downward move in an instrument creates a rise in implied volatility locally, and we get a rise in implied volatility kind of on that macro or global level. So maybe we start to look at some of the individual names here. So let's take this into account. We're going to kind of follow this in two directions. We're going to follow this to the area first of low implied volatility mega caps and see if that lower implied volatility indicated by the VIX, regular VIX, is something that we can trade as a long option trader. And then we're going to go to the other side of this equation where implied volatility is high and see if we can deal with that as a long options trader. So I'm going to change my grid here really quickly to the my single grid. Now, by the way, I'm just going to ask a real quick question out there in the chat because I know that we've got a number of new folks here in the chat. I also know that we've got a number of people that are here all the time. Some of you guys, I see your names all the time. Like every time I log in to teach a webcast, you're there, which is kind of cool. At the same time, I got to say, okay, every time? Yeah, and I would argue, Chris, you're right, that earnings season does complicate this because it spreads that systemic risk, that specific, well, not the systemic, but the specific event risk across some of those smaller names because they're going to report earnings too. They're just not the ones that are being watched as closely. So the question that I was going to ask out to you guys in the chat is this. How many of you have ever looked at VIX EQ, the VIX of the equal weight, as a measure of volatility, or is it something that's just not even on your radar? What do you think? No, I'm not knocking that. I love that. Josh, by no means am I knocking that. Please keep coming. Absolutely. So here's the one that I'm looking at. This is NVIDIA. Now, here's the thing. NVIDIA, NVIDIA is one of those names. I mean, this is the mega cappy of the mega cappies stocks, right? I mean, it is what it is. So from this standpoint, I've got a bullish bias to this trade, right? I've got a bullish bias to this trade. The bullish bias here is kind of belied by the fact that implied volatility is a little bit low. So I'm not going to get necessarily that double kicker. But we're still looking for a rise in implied volatility to a certain extent if implied volatility overall in the mega caps is low. All right, so Sam, let me explain, all right, really quickly. So SPX is a cap-weighted index, meaning that the biggest influence of that index are the largest market capitalization stocks, like NVIDIA. So when you look at VIX, the volatility index, that's reflective of the volatility induced into the S&P 500 index by those mega caps. But if you go to VIX EQ, now you're looking at all of the components or the constituents of the S&P 500 without the market capitalization weighting overlay put in place. So what that suggests is that even though implied volatility might be low in some of the mega caps, which is what's driving the VIX lower, the VIX EQ is significantly higher because if you look at the average of implied volatility across all of the components equally, it is a much higher state of volatility than it is implied on the VIX chart itself. So we're going to take the low implied volatility side of this spectrum first, and then we're going to go to the high implied volatility side of the spectrum. So here's NVIDIA, and it's kind of sitting at this little bit of a kind of a reverse cup and handle, or a handle and then a cup type of pattern. And my good friend Rachel Deschelle would probably be, um, would be chastising me if I didn't draw this pattern out. So this is a handle and a cup type of pattern, similar to an inverted head and shoulders, similar to a cup and handle type of pattern, where you get a little bit of a pullback into a support level and it rallies, and then you get some more selling. And so support level here, looking for a breakout of that neckline or that rim of the cup right here. So looking at this from a bullish perspective, implied volatility is relatively low. RSI is moving higher. So momentum is moving up. We're kind of at that breakout point here at this particular point, looking for the breakout. We don't have the breakout yet, but it's up 4% today, right? It's up almost $8 today in this particular case. So we're looking for this to move bullishly. So I'm going to look at taking a long call option trade here on NVIDIA. Now, the RSI, that relative strength indicator, I know that I've got that upward movement. So I'm going to hide that so that it's not cluttering up my view. I'm going to hide my RSI. So now all I'm looking at is implied volatility. I'm going to zoom back out a little bit so I get the whole year of implied volatility. Implied volatility is not the lowest that it has been in this particular chart. Yeah, you're right. Or maybe you're making a right-hand shoulder. Either way, Chris, we might be looking for a breakout at some point, right? But implied volatility is not the lowest it's been, nor is it at the high. The highest it's been was back in the October timeframe over the course of the last year. The lowest that it's been was back down here in January, February. It's now towards the lower end of the perspective. Current implied volatility percentile is down around the 40th percentile. When implied volatility is low, it often goes up. Now, we've got an earnings announcement a little ways over the horizon here, so implied volatility is likely to rise into that. All right. I can use either one, Koala. ADX is going to give me a trend strength gauge for sure, and I do that on my in my futures chart. Here I'm using the RSI just as an indication of momentum, same kind of thing. But I'm looking for a move back up here to maybe up around that 235 mark. That previous high would not be outside the realm of possibility, and especially given if this were a symmetrical movement to the upside. So that's kind of what I'm looking at for my directional expectation. Implied volatility, expecting implied volatility to rise somewhat. However, implied volatility doesn't naturally tend to rise when prices go up, unless you get a lot of call buying happening. So I'm going to go to the trade tab for NVIDIA. I'm going to scroll down here to the today's option statistics section, and I'm going to look over here in this area right in the middle. Right in the middle. This stuff right here. Okay, so here's what I see happening here. First of all, I see that I've got total volume, a lot more calls than I have puts, right? So I've got a lot more calls trading here than I do have puts. So there's more calls being transacted. Now, whether that's covered calls at this resistance level being sold, whether that's calls being bought, but here's how I might imply or infer that information. So if a call is being sold, generally that transaction is going to go off at the bid or lower. So that out of this volume, now total volume, I can see that about 483,000 of the calls are going off at the bid or below. I also see that just about 200,000 more of those are going off at the ask or above. And then the rest of those are going off in between the bid and the ask. So what this is telling me, and this is an inference, this is not a direct link, but this is telling me that those that are going off at the bid or below are being sold. Those that are going off at the ask or above are being bought. And then these that are going off between the market are being bought or sold, and maybe as part of a spread. So I'm going to put that as BS. I'm putting a slash in there so that it doesn't seem inappropriate. Be either being bought or sold. So right now I'm seeing that this is leaning more towards the idea that there is call buying happening. Now, the other side of that coin is if we go over to the put options, I see that the majority of those puts are going off at in between the market. So there's probably some put spreads being sold that are a little bit more bullish. Now, remember, if I'm looking at people buying puts, traders buying puts, I'm going to see that happening at the ask or above generally, right? And if they are selling puts, they're generally going to be selling at the bid. So I've got more selling going on. This all leads me to think that there's some bullishness afoot here with NVIDIA at this resistance level, because this suggests that more puts are being sold than are being bought. Why would people buy buying puts? Because they're bearish or they're part of a spread or they're hedging. Why would they be selling puts? Because they're bullish or it's part of a spread. So my perspective here is that there is a slight bullish edge to NVIDIA at this point based on this option statistics information. Current implied volatility percentile is actually a little bit lower than I thought it was. It's down to the 31st percentile. So when it's in the lower portion, and especially below 30, it has a tendency to rise. And so if you've got a lot of people buying calls, guess what? Buying calls is going to drive volatility higher. That's going to be beneficial for a long call trader. Now let's get to the trade. Now that we've kind of done the preliminary discussion here, let's think about what it is that we want to accomplish. So I'm going to go back over here to the charts. And I know that implied volatility is likely to rise into an earnings announcement. So I'm going to open up my right-hand side and I'm going to find where that next earnings announcement is. And it's out around the 26th of August. So I want to be in this trade and out of this trade before that earnings announcement happens to come along and crush implied volatility. So here's what I'm going to be looking for. I'm going to be looking for a trade that closes out sometime, maybe 4 to 10 or 10 to 20 days prior to that 8/26 earnings announcement. So let's back it up 10 days. I want to be out of this trade by 8/16, by the 16th of August. So I'm going to go back to the trade tab and I'm going to scroll back up here in my list of expirations and I'm going to say, hey, is there an expiration date that is before the 16th of August, before 10 days to go until that earnings announcement? And sure enough, there is a 14 expiration, which is 31 days from now. So that's what I'm going to be targeting. And I can also see that that's got relatively low implied volatility over here on the right-hand side. So the 14 expiration has about a 43% implied volatility, and that's about a 21-point expected move, about $21 expected move. So that puts me up at around, from where the stock is trading now, $211 plus $21 puts me up at around $232. Let's look at the chart. $232 in about 31 days puts the price of the stock right up here, maybe somewhere in this range right here, kind of that little target box, if you will. That's what we're shooting for in terms of our directional opinion. So cool. That's what I'm thinking the stock is going to do based on this move or this idea, this opinion or premise that I have. And I'm going to do it ahead of the earnings announcement so that implied volatility, if it is rising, is likely to stay high and it's not going to collapse on me ahead of the earnings announcement. Now, NVIDIA tends to hold its implied volatility until very close to the earnings announcement. It doesn't always collapse prior to. So that's what I'm shooting for, is that type of move right there. So I'm going to go back to the trade tab. Now I know when. Now I need to know where, what strike price I might choose. So we're at the 14 expiration. We're going to be on the call side because we're talking about bullishness, right? We're talking about a bullish bias. So I'm going to scroll back down to my at the money strike. I'm displaying 50 strikes, 25 up and 25 down. I've got fairly tight bid-ask spreads here. These are 20 to 30 cents, depending. And my thought is, considering the fact that this is going to be a relatively short period of time, I want to decrease the impact as we're getting closer to expiration, decrease the impact of time decay on this trade, and maybe give myself a fair chance to see some impact from implied volatility rising. So I'm going to balance using what I know about my option Greeks. I'm going to balance my option Greeks somewhere in this range. Some intrinsic value, right? Some intrinsic value, but I've got now, I want to be kind of in that range where intrinsic value is balanced by directional sensitivity, time decay, and vega sensitivity. Now, Sharon says, why not the 21st of August? You could certainly do that. You could go out to the 21st of August, give yourself a little bit of time beyond that if you wanted to. That's fine too. I want this because I want to be out of this trade even if I don't take the trade off and I just hold it in place, which I'm not likely to do. But I want to be out of this trade prior to the earnings announcement. So I could go to the 21 August. That's not a problem. Because theoretically, I could sell that time value back to somebody else if I were to exit the trade. That's never a guarantee. But the presumption is that there would be theoretically a liquid market for that time value and for those options as we get closer to expiration. So I want to be somewhere in this range. I want some delta sensitivity here. I want something that's going to have some teeth to it if the price of the stock really takes off and continues to move to the upside. So I'm going to go right here. I'm going to go to the 70 delta option. That's a little bit deeper in the money. It's a 200 strike delta, so it's about 11 points in the money. I know that's got about $11 of intrinsic value. So Trader Joe, here's the thing. With VIX EQ being higher, we want to buy a long call. Why would we want to buy a long call? Remember the explanation when I said when VIX EQ, which represents the overall constituents on an equal weight basis, is significantly higher than the implied volatility indicated by the VIX itself? That tells you that the implied volatility of the major components, the biggest drivers of the S&P 500, like NVIDIA, is likely to be very low. So if it's low and everything else is high, guess which direction that implied volatility is likely to go for something like an NVIDIA? Up. There you go. Okay. So here we go. Now we're looking at that 200 strike. And so to answer Alexander's question as well, that's how we found this particular trade, because we know that NVIDIA is one of the mega cap components of the S&P 500. So here we have that 70 strike, 16 cents of theta, and that's going to increase a little bit as we get closer to expiration. But here's the thing. If our directional opinion is correct, then guess what's going to happen? This 200 strike is going to move deeper in the money. What happens to the theta sensitivity of options that move deeper in the money? It goes down. So even if we get closer to expiration, we're going to be mitigating some of that time decay as well. Now, that also occurs in terms of Vega, but here's the thing. Right off the bat, if implied volatility starts to go up, if the overall market starts to see that higher implied volatility, then we know that Vega gets less as we get closer to expiration, and it gets less the further in the money we go. At least at the outset of the trade, we're getting a fairly healthy Vega sensitivity in this particular case, right? So higher VIX EQ can be a somewhat bullish sign when it comes to the mega cap names, but it may present some additional risk in terms of the smaller cap or kind of more of the other stocks, stocks also listed, right? So yeah, we could buy out to September. That's going to lower theta sensitivity as well. Yeah, for sure. Again, it's always a balance. There's no absolute right answer here, which is what's so cool about trading options, guys. That is what's so cool. And I'm not saying that as a recommendation for trading options. I'm saying that because it's an interesting activity. It's an interesting mental exercise to try to trade options and play this game. So I'm going to go to the 200 strike. I'm going to look at buying this 200 strike. But before we do that, I'm just going to play the what if game real quick. So I'm going to change my layout to Theo Price and Mark. Pay attention to, let me reset this. Okay, pay attention to this. So we're watching the Theo Price and we're watching the Mark Price. So what I'm going to do is I'm going to play the hypothetical. I'm going to say, all right, what if now we go out to, let's say, the 7th of Aug? And what if the price of the stock makes that 21-point move to the upside, and now we're at 232? What's that option likely going to be worth? Paid $16.80 for it, likely going to be a 50% or a 100% increase in that trade, doubling it up to 32.26, right? That would be ideal. That's without any change in implied volatility. That's just the time decay and stock price movement. That's what we're looking for, right? In this particular case. All right. So that's the expectation in this case for putting this trade on. Is it going to get there? Not necessarily. $16.95 is what each share is going to cost times 100 shares, $1,695 per contract is my risk in this trade against infinite maximum gain. Doesn't guarantee that that's going to happen because infinity is not a guarantee, but it can happen, I suppose. It's not likely. So we're going to put this in our long options group. We're going to click on send and we're going to fire that order off. And I just placed that as kind of hitting the midpoint. You can always try to work that a little bit inside that mid and see if you can get a little bit better in this particular case. Yeah, so now there we go, looking for that bullish move, right? Now, let's take the other side of this equation. Because if we go back to our charts, and let's kind of go back to our discussion that we were having before about VIX versus VIX EW. Here's VIX EQ. That's really high. So now if we've got something that has a potential to move and we want that implied volatility kicker, where do we have to go? Well, maybe we got to go to some of those other constituents of the S&P 500 that aren't the mega cap players. So you know where I'm going to go? I'm going to go right into the teeth of implied volatility at the moment, and that is in the banks. So we're going to go to some of these names. In fact, some of these names that had earnings today. I'm going to go to this one right here. Let's go back to our chart. And let's go to our single grid, and let's take it to JPM. JP Morgan, coming with earnings today. So look at what's going on here. And this is really kind of cool. I'm going to zoom in over on this right-hand side. I'm going to kill some of these drawings that I've got on here. But notice what happened with JP Morgan today on this earnings announcement. I'm going to remove that one. Look at this level of support that's here. Right about the 326 level. I'm just going to activate that. I'm going to drag that over. So here's what happened. We had a gap down, earnings announcement, boom, rally, running back up into this resistance level. Does that mean it's going to continue to move? Not necessarily. Does that mean that it could potentially continue to move? Yeah, it's kind of still holding the midpoint of that day. Look at where implied volatility is gone. RSI is starting to move up a little bit again, but look at where implied volatility is. Now that we're at earnings announcement, all that implied volatility, all that implied volatility got sucked, almost all of that implied volatility got sucked out, right? Okay, so cool. Now, here's the thing. With that type of low implied volatility, that gives us a little bit of flexibility, in terms of putting this trade together. Now, Sam, I'm going to address two things here. One, the definition of your risk in that trade is the amount that you're paying for the trade. Could you put a stop on it? Could you put some kind of definition of that risk other than the amount that you could lose because of what you're paying for the trade? Sure, go ahead. Second, A bull call vertical spread sure would have been less expensive, but guess what? The title of this particular webcast is Long Options. We have an entire webcast that focuses on short vertical spreads. So that's where we would talk about that one. So now we're looking for this bullish move and looking for a potential breakout of that resistance level with low implied volatility, right? And as we've got that low implied volatility, let's go to the trade tab. Let's see what we can do with this trade. Let's see if we can get there. Here we go. All right. So once again, I'm still starting with kind of that basic definition. So now here's the thing. A lot of calls going off at the ask, meaning there's call buying going on here. A lot of trades going off between the market, which means that there's buying and selling going on. But the majority of those trades happening in between or at the ask on the call side of the equation. Puts are kind of balanced between buying and selling puts at the bid or the ask. So we kind of see that there's maybe a lot of spreading activity going on, maybe a little bit of hedging in this particular case against this upside move. But that means also that these call options are going to be relatively cheap. So I'm going to look over the horizon here a little bit, and I'm going to go out to this one right here, the 21 August. So back to I think somebody commented on maybe using the 21 Aug expiration. So let's use that. Let's use the 21 August expiration. 38 days to go until expiration. Implied volatility in this particular case. Whoops, let's change that. Let's change that layout back to delta, gamma, or excuse me, delta, theta, and vega. Implied volatility relatively low, and if implied volatility goes up, that's going to work in our favor. So we're going to look once again, because we're now at this point where implied volatility is low, we're going to look at taking advantage of that low implied volatility and the continuation of that move to the upside. But here's the thing. Given the fact that the price of the stock has now moved up and it's at a breakout point and implied volatility is very low and there is that potential for this to move higher, I might be a little more aggressive in my expectation for directional movement. So I'm going to look at buying an option that maybe is a little bit cheaper. Now, here's the thing. Lower probability of success, but a little bit less and a bigger bang for the buck if it does move. And then we get the double kicker if implied volatility goes up. So I'm actually going to go out just a little bit here. I'm going to go out to the 350 strike. That gives me about, and this is a little bit unusual because normally I'm going to go in the money just slightly to get a little bit of intrinsic value. But I've got an expectation here. I've got an expectation here of going a little bit out of the money, seeing a little bit more directional movement. I'm paying a little bit less for it, so I'm willing to take this as a more speculative trade. So I'm going to go to the 350 strike. Now, stock's currently trading at 338. My expected movement within this time frame is 20 bucks. So that's going to put me kind of right at that area. But if it goes up and there's some call buying and it gets that kind of FOMO behind it, I'm looking for this implied volatility to rise. And I'm looking for this implied volatility to be pretty healthy. 40 cents per percent of implied volatility increase. I might even mitigate this a little bit, but that's a dollar-wide bid-ask spread on the 345. So I'm going to go to the 350, which is only about a 40-cent wide bid-ask spread. And I'm going to buy that one. Now, before I do that, I want to look at my Theo Price and Mark once again. We're going to reset this, and we're going to say, all right, let's go out, and let's go out about a month in time. So we know that this expires on the 21st of August. So I'm going to go to the 7th of August, and I'm going to say, hey, what if we get a 20-point rise in the price of the stock? What does that do? Paid $5.70 for it. It's now worth 11 bucks. So once again, cheaper cost, but bigger bang for the buck. We're still getting about that. In that case, it's about an 80% increase or 80% return on that risk, but it's a lower initial investment and a little bit better bang for the buck in this particular case. Doesn't mean that that's going to happen, but that's kind of the way that I'm looking at this trade. So we're going to come back here. We're going to look at buying this 350 call. Now, the other side of the coin is if we were to just let this go, has no intrinsic value. So this has to have some directional movement. So it's a lower probability trade for sure, lower probability trade. So you got to put that in the perspective. I'm gonna walk this back towards the mid and maybe work that down a little bit. See if I can get this a little bit cheaper. Work the order just a little bit. I'm gonna click on confirm and send. We're gonna read through this order, make sure that this is what I want to do. But my net cost of the trade, $575. That is my risk in the trade. If my account does not support that in terms of my position size, then I need to change things a little bit. So that's something that you need to ask yourself. Scott does a great job with that in his trading stock, in his introduction to trading stocks webcast, and I think he's put the link out there as well. But that's a good conversation to have. How much can I trade in terms of position size? So we're going to put this in our long options group. We're going to click on send, and we're going to fire this order off, and we'll see if we get that. We might not get it, but we just did. So now we are long this call on JP Morgan with that low implied volatility and expecting that implied volatility is going to rise. So there you go. All right, that's where we are in terms of the way that we put this trade on. So a couple of different ways. And by the way, remember, there's no one best way to trade anything. There's no one best way to trade anything. All we're doing is we're looking at the possibilities and basing what we can do in that circumstance based on our opinion and what we know about the characteristics of trading. Because we can buy a call and we can sell a call, we can buy a put and we can sell a put. And we know that we've got three major influences into an option trade: price, time, and volatility. So that's the mix that we're working with. And we can throw that into the pot and stir it around. And what we come up with is a balance of what we want to try to accomplish. What we're trying to accomplish with these trades today is take some directional movement with implied volatility. You could put a stop loss on those trades if you wanted. I typically don't, but I will typically put, and we've done this in another class, put a conditional order on that so that if the price of the stock moves, then it takes the options trade out. The challenge with putting a stop loss on an option is that intraday volatility in option prices and the width between the bid and the ask spreads can take you out of the trade before it even has a chance to be successful. So we're going to pop in here really quickly: conditional orders, options, and we'll see what we get in our webcast page using conditional orders on stocks and options, conditional orders with options, guide play option orders, the power of conditional orders and weighting, conditional orders for directional patterns. So lots of different great webcasts that you can use, right? So there you go. My thanks to Scott Thompson for helping out. By the way, if you're going to be in the Chicagoland area, we're going to be in Schaumburg on Friday and Saturday doing technical analysis and option strategies. Then if you're in Dallas, we're going to be in Dallas on August 1st with our one-day market drive event. Come and join us for that. And then if you're going to be in Orlando, August 7th, August 8th, we're going to be doing technical analysis and option strategies there. And then we're going to be in New York doing advanced options. So come and join us for any one of our live events. They are at no cost to you. We'd love to see you there. This is where you get to it, schwab.com/coaching/live events. Love to see you there. My thanks to Scott Thompson for helping out. My thanks to all of you for being here. Bree, our great production staff, and our great reviewers. Have a good day, everybody. We'll see you soon. Take care. Bye-bye.